Hello, everyone. I'm Sean Walters, and welcome to the Exceptional Advisor podcast, brought to you by the Investments and Wealth Institute. We are relaunching the podcast with a sharper focus, monthly conversations on the issues that help good advisors become great advisors. And there's a lot of big names, powerful guests we could invite to this podcast, but we really want to focus on professionals who help you better serve clients, run better teams, make better decisions for your clients. Each month, I'll sit down with leading thinkers and practitioners to unpack what matters, what's next, and what you can do with it. So to be clear, I'm not an advisor. I run an association of and for advisors. I've been working within the financial planning and wealth management professions for almost 30 years. I really have learned a lot about the advice profession, what matters to advisors, and really how to provide content that's of value to advisors. So I'm really excited that our first guest is Liz Thomas, head of investment strategy at SoFi. Liz is an investment strategist that's kind of a fan favorite for the Investments and Wealth Institute membership. She also hosts a podcast called The Important Part. If you enjoy this podcast, it's more because of Liz and not so much because of Sean, so you might want to check that podcast out. Her job is to translate what's happening in the economy and markets into clear, actionable insights. And she's been doing that across a variety of roles, BNY Mellon, BMO, Baird. She presented at our New York Strategy Conference in November of 2025, Watch Your Tail Risk. And it was once again, because she presented the year before in Chicago, the highest rated general session on that program.
First of all, thank you for having me. I'm flattered to be here, especially for the relaunch episode. So excited to be the one to kick it off.
I'm really thrilled to have you join us because you've been great at translating the macro into actionable ideas for advisors. So let's kind of start with just something about how you got started in the business. What was the most influential person early in your career and someone who made you kind of feel like you were on the right path?
Early in my career, my foray into real investments and into the investment strategy realm happened when I was in my late 20s. I've been in the industry now for this will be my 22nd year, that is a terrifying number to admit because I still think of myself as young. And now when I'm saying I've been here for 22 years, I don't feel young anymore. So um, early in my career, I had an opportunity that, frankly, I was surprised to get. And at the time, I was working at a regional bank in Wisconsin, regional bank in Milwaukee. It was called M&I, Marshall and Ilsley, and it was later bought by BMO, so eventually it turned into BMO. But I had been in the trust operations department working in investments, but operationally, and wanted something else, and I'd been looking for a while, and the HR gal that I'd been working with at the company said, "Hey, why don't you apply for this role? We have our chief market strategist in the investments division. He needs an analyst. He's interviewed like 100 people. He doesn't like any of them. And I don't even really know what he's looking for anymore. So why don't you give it a shot?" And I looked at the job description and I thought, this is way beyond my experience. This is way over my skis. So I kind of resisted and she pushed and she pushed. So finally I went and I talked to him, had an interview with him. I think I was the last person he interviewed. And he gave me a shot. We had good chemistry. He was in his late 60s when he hired me. So he was in the twilight of his career at the time. And he wanted somebody to mentor. I very specifically remember him saying he wanted somebody who was young enough that they didn't have any bad habits yet. And I was certainly in that camp. I was young and I was green. And he gave me my first shot. And he taught me so much. I only worked with him directly for 2 years. I learned more in that 2-year period than I think in any 2-year period for the rest of my career. So he gave me that shot and he showed me what an option was in the financial services industry as a job for somebody who wanted to communicate, but also be analytical and to be able to marry those two things. He was the one that gave all the client presentations. He was the one that was on CNBC. And I was the one that was building the presentations or sending talking points to the producers at CNBC. But I just remember thinking like, wow, how cool is that job, right? And someday, maybe somebody will give me a job like this. I didn't think it would happen until I was in my 50s or much beyond where I was when I actually got the shot. But that was really a turning point, and he also convinced me to register for the CFA program, and go through that. So, that it was a real turning point in my career. We still talk today. He's long retired, but we still talk, and he means a lot to me. He means a lot to my career. He really did change the trajectory of my life.
Yeah, it's such a great story, and there's so many stories like that. That's why I love the work that I do in professional associations. You mentioned the two factors that tend to drive people through a career is the community, the mentors, the people,
Mhm.
but then also the knowledge and skills which you earned in a great deal through the CFA program and, associations advance America type thing. So appreciate you telling that story. And now you're in the hot seat with all my difficult questions.
Oh, boy.
Now, it's really been an interesting past week. I was reading your blog and watching your most recent podcast.
Mhm.
So let's just kind of start broad, the base case. Give us your base case in three bullets: growth, inflation, rates, and maybe what's the one swing factor that could change the picture.
I'm trying to figure out how I wanna frame this, because I don't think we can take each of those independently because they all affect each other, and I guess I'll start with the latest Fed statement that we got in December included, as it does each quarter, uh, included the summary of economic projections from the Fed, and they give us things like, what they think growth is gonna look like in the year to come, what they think inflation will look like, where they think the Fed funds rate will be, all of these details. And what was interesting in it was that the median Fed funds rate was expected to be lower than it is right now, so expecting one cut in 2026, except growth was expected to be higher. Inflation was expected to maybe go up a little bit, or if not, just kind of stay steady. And unemployment was expected to stay steady. So then, how do we explain if growth is stronger, why they would cut rates? So there are some inconsistencies in even those expectations. So I say that because I think we focus so much on what the Fed says as if they've got some special insight into how the year is going to play out and how growth is going to play out and how inflation is going to play out. Yes, they have sophisticated models, and yes, they have people working on this every day of the year. So perhaps they have more data, they have more views into it than the layperson, but the reality is they have to react to the data just like any of us do. So when we look at what's the base case for growth? The base case for growth so far this year has been positive, if not more positive than anybody even expected, right? The expectation for really strong growth in the fourth quarter. I believe the last Atlanta Fed GDP Now forecast was above 5% expectations for the fourth quarter. And in 2026, growth expectations are strong. So I think that can stay intact. Inflation expectations, there's a difference between inflation expectations and the inflation readings. So, inflation expectations are more of a longer term view. So, you look at things like what's the 5-year inflation expectation or the 10-year inflation expectation. And that's what the Fed watches as well. What they want, and frankly, what all of us should want, is for those expectations to stay anchored, to stay under wraps. Now, the shorter term movements in an immediate inflation read, or maybe a much shorter term inflation expectations read, something like 3 months or a year or something like that, expected to be more volatile, of course. But as long as those long term expectations stay contained, inflation is in a decent place. I want to make a big asterisk on that because inflation in a decent place still means it's positive, still means that it has gone up since 2020, frankly, of course, hit its peak in 2022, but has still continued to rise. It didn't deflate. Nothing deflated. Prices didn't come down. They just stopped growing as fast as they were. So consumers are still under stress because of that. not under as much month-over-month stress as perhaps they were. It's not as dramatic as it was, and we're not in this state anymore where we're, upset about beef prices this month and egg prices next month and used car prices the month after that, where we were sort of in this whack-a-mole scenario. So inflation is under control, but still a question mark for policymakers, still a question mark for investors, and still a point of contention and an element of stress for consumers. So I don't want to send the message that, okay, inflation, is solved. The problem is solved. It's not solved. But do I see it suddenly inflating to a material extent in 2026? Not unless we have some more geopolitical tension that really drives resource prices that much higher. So the inflation picture, I think, is okay. The real topic for the Fed and probably for investors in 26 will continue to be the labor market, because that's the one that's sort of on the precipice, right? It's like on this teeter-totter of it's been it's been really, really tight, and then we got it to a balanced position, and now it's like, all right, we just need to keep it at balanced because it's right on the edge of tipping over into concerning. And it appears so far this year that we're keeping it in balance, but that deserves a big asterisk too, because as we know, the government shutdown in fall affected many of those economic readings. So we don't necessarily have good data for all of October, right? Or we didn't have it until much, much later, and the market had already reacted to certain expectations. So the labor market will play a big role this year. Uh, and I would expect that it probably weakens a little bit, but I think the bigger risk is that we're so used to such a low unemployment rate that anything above 4.5%, people get really concerned. In reality, 4.5% is a normal, and if not historically low, unemployment rate still. I think it doesn't really become a concern until it gets to 5.
Yeah. Great overview. I think the labor question is one of the bigger swing factors. A lot of my peers, I'm a CEO, I run a company of 46 people. We're just kind of holding tight, we're not shedding positions, we're not adding positions. A lot of my peers are doing a similar thing. So that's probably a good lead in into the dashboard then for 26. What do you think advisors should be looking at in terms of
Hmm.
maybe 3 indicators in 26? What would you pick to watch if you were an advisor?
Yields. Can I choose yields for all three?
Yeah, you can.
Yields would be in the number one spot. Um, I mentioned earlier this obsession we have with the Fed. We obsess over the Fed funds rate. And uh, I understand why we do, because the announcements do move markets, and the Fed is important, and the Fed funds rate is important, but it doesn't have as much power as everybody suggests it does. The Fed funds rate does not track mortgage rates, right? I hear this time and time again that, well, if the Fed would just lower rates, mortgage rates will come down. Mortgage rates track the 10-year Treasury yield. And in fact, the last few times, and even in 2024, when the Fed cut rates, the 10-year Treasury yield rose. So the Fed funds rate coming down does not directly bring the mortgage rate down. So I think that needs to be thrown out the window. Watch yields instead. The other thing is the idea of the Fed cutting rates somehow helping the labor market. Lowering the Fed funds rate does not create jobs. There is no direct effect there. I mean, you could probably take this, a few steps further. And what does it do in the economy? It allows companies to have more liquidity. Maybe it allows them to issue more debt. It makes their debt less costly, so they have more capital left over, so they don't have to fire people. But that's like, we're in the second, third order, sort of effect there that I don't want to rely on 3 or 4 steps after a Fed funds rate cut to feel assured that somehow companies are going to hire again. That's not really how it works. And in fact, cutting cycles are typically when unemployment rises, not falls. So some of these ideas that are out there as theories, or that are out there as suggestions of why we should watch something like the Fed, I think you watch yields instead. And what we've seen over even just this year, partly because of geopolitical risk and other things that are going on in the economy, the Japan yields rising quite a bit too. We've seen 10-year yields rise. We've seen a steepening in the yield curve. And that sometimes can signal good things. It can signal that, growth is strong, the economy is moving forward and expanding. In this case, I don't think that's what it signals. Right now, I think it's signaling less confidence in fiscal spending, less confidence in the fiscal situation, and even just this nationalism around the globe because other countries are having a hard time setting expectations for what the US is going to do. That's not necessarily, I'm not saying it's anybody's fault. I'm not saying that anybody is really all that angry. I'm sure there are angry people out there, but I'm not saying anybody is all that angry necessarily or doing anything wrong. It's just that this continued geopolitical volatility and geopolitical headline flow has made it really difficult for our trading partners and other countries to set expectations for the year on how that might look between them and the United States. So pulling that all in has affected treasury yields. It's affected bond yields around the globe, frankly, but it's affected treasury yields. So that's the one of the first things, if not all three of the things that we should watch this year. I already mentioned the labor market. Here's a fun little tidbit. You can watch the headline stuff like the unemployment rate or jobs added, all the stuff that, makes news every single month. But you also need to watch construction employment because construction employment leads the broader labor market. And it leads it by a while. So let's call it 9 to 15 months or so. So there's no specific time frame. But if construction employment starts to roll over, and right now it's sort of at a plateau, there's nothing necessarily concerning, but it's certainly stopped rising. So if construction employment starts to roll over and turn down, that typically leads a broader rollover and downturn in the labor market. So that's something, another thing to watch in 2026. And then I would say the last thing that's much more market related to equities, because that's frankly what we talk about so much, is where the earnings growth is coming from. I don't think it will surprise anybody if tech continues to be the leader in earnings growth, but where is the other earnings growth coming from? Right now, the expectation is that materials will be the second best earnings producer in the S&P 500. I think it would be great if that ended up being the case. I think it would also be great if something like industrials or energy or consumer discretionary or financials ended up in the number 3 spot. So that's something to watch too, because it will help confirm this broadening out that we've seen in the market already, where other sectors are coming in and shining. They're not going to be able to bring returns up as much as tech just because they're smaller weights in the index. But earnings coming in strong for some of those cyclical sectors that are now coming into the forefront would be a great confirmation factor for the year.
Yeah. Well, and you may have answered this. I think you answered my third question for you, which is what's the most underappreciated risk to markets in 2026? Or unless you think there's something else that is underappreciated risk that could affect the markets in 2026.
Yeah,
You mentioned geopolitical earlier.
that's not underappreciated, though. I think
No.
that's very
Yeah,
appreciated.
yeah.
I think markets are knee-jerky about that and will continue to be so. Uh, Probably the most underappreciated risk is that we actually overheat again or start to overheat again, and the Fed has to shift approach. We've been waiting for rate cuts, and I think this is a very outside probability. I don't think that this is something that's very likely to happen, and it's certainly not likely to happen in the next few months. So if anything, this would be second half. But let's say things go much better than expected, and as investors, we're not used to saying that, right? We're used to trying to figure out where all the risks are, where all the bodies are hidden, and we're not used to saying, "Well, what if it all works out better than I thought?" So, what if it does? And what if growth comes in stronger? And what if earnings come in stronger? And what if the consumer continues to demand more goods and services and inflation picks up again? And the labor market is pretty stable. And the Fed has to basically say, you know what, we cannot justify another rate cut. We can't even justify one. So that narrative shifting could play a major role in markets later this year. But I think even the risk of that has come down over the last month because now we've priced out a rate cut until July. The market isn't even expecting a full rate cut at this point until the July Fed meeting.
Yeah, I won't even get into the Fed chair and the new Fed chair and how that might affect that environment you just laid out as well. So let's shift though to where advisors are living every day: concentration, mega themes, managing client expectations. there's been this kind of AI concentration and managing, the FOMO risk. Markets have been dominated by a handful of mega themes and mega names. What's your playbook for reducing that concentration risk? You talked about, what's behind tech? What is the next equity? But what are your thoughts on what advisors should be looking for in trying to manage that concentration risk?
Yeah. So here's the good news, and I put this in the outlook, my 2026 outlook, because the way that I framed the outlook this year was, all right, what are the big concerns that almost every investor has about this market? We're worried about valuations being too high. We're worried about capex spending getting ahead of itself, and we're worried about concentration. We're worried about all this reliance on the big tech names and even just the Meg 7 names. And in the outlook, I talk about the big 11, which is the Meg 7 plus some of the hyperscalers, things like Oracle, Broadcom, AMD, and Palantir is in there too. So basically, all these names that have been in the headlines as the ones that are driving the market, right? But we've been worried about this concentration. And I tried to basically debunk those concerns if possible. Should we really be this concerned? And if it is a bubble, maybe it is. I don't know. I'm not going to be the one that defines that. If it is it really ready to pop, or do we have some more time before that happens? And what we concluded is that perhaps it is a bubble, perhaps it's getting a little unhinged, but it's not time yet. It's not irrational enough yet. It's not exuberant enough yet. It's not extreme enough yet. And the concentration risk in particular, I think, number one, and again, this chart is in the outlook. I just was trying to pull it up so that I would get my numbers right. The total return in the tech sector plus the Meg 7 since 2022 has been 185%. That's a huge number, okay? The rest of the S&P, the return over that same period has only been about 34%. Pales in comparison, okay? But like 34% in any other period, I'd be like, that's pretty good. I'm okay with that. Then you look at what's driving it. Have earnings actually backed that up? And they have. The earnings growth in that same subset, so the tech sector plus the Meg 7, has been 106.5% over that period. That's a big number for earnings. And in the rest of the S&P, it's only been about 17%. So prices have followed the fundamentals too. And I think that's something to keep in mind. Yes, concentration can make the market fragile because we're so dependent on those names, but the fragility also lies in how durable are those names. And if we do this, exhaustive comparison to the dot-com bubble, these names are not nearly as fragile as those were because those didn't really have earnings yet. They didn't really have a concrete use case. They certainly didn't have the user base that was already existing before any of this AI came to be in companies like Amazon and Google and Apple, right? The existing user base, which is what you need that. I'll call it foot traffic. I think everybody knows what I'm talking about, but it's not actual foot traffic. But the people that already exist, the customers that already exist. So the fundamentals of this move are there to back it up, and I think that should be comforting. That said, what's happening in the market now and what's actually been happening since that November low in 2025 is that the concentration risk is diminishing because Meg 7 tech, has not been the leader. And in fact, the leading sectors coming out of that low in November were healthcare, materials, industrials, right? And even through the end of the year, financials did well. So the fact that these other sectors are coming in and continuing to do well, and things like the equal weight S&P outperforming the market cap weighted S&P, or things like the value index outperforming the growth index and even hitting a new high before the growth index in the last month or two. Those are good signs, and those do reduce that concentration risk. So as investors, what do you do about it? Well, number one, you make sure that you have exposure to other things, and some of the more specific things that I call out in my outlook are sectors like materials, healthcare, staples. I think that those are good spots to be. I also think you can look at companies that have a lot of free cash flow and are fundamentally healthy in that way. There's actually an ETF you can buy. It's called COWS. The ticker is COWS for cash cows, COWZ. So companies that are generating good free cash flow. And I think gold still has a good spot in portfolios. I can't believe I'm saying that, but it has outperformed the S&P for the last 2 years, and I don't think the demand is going anywhere. So that has a spot. I think emerging markets, particularly China, have a chance this year too. So looking out in other places in the portfolio to make sure that you've got exposure is the way to do it.
Yeah. No, and you had a great blog 2 weeks ago talking exactly about what you just discussed. The one this week had to do with bonds, so I want to follow back up and talk a little bit more about
Mm.
what you see going on in the bond markets. You of course mentioned yields earlier, so talk a little bit more about what's your outlook in the bond markets for 2026.
I think the bond markets are gonna be really interesting in 2026, and I don't think we pay enough attention to them. There was, for a while, this prevailing wisdom that, well, the bond market is broken, it's manipulated, it's not sending signals like it used to, because for a long time, the theory had been that the bond market was smarter than the stock market, or that the bond market knows stuff before the stock market does. Uh, it certainly has been affected by monetary policy, it's been affected by fiscal policy, and it continues to be so, but I don't think the bond market is broken. I don't think that it suddenly, doesn't mean anything if yields move in certain directions. So, um, I think there's gonna continue to be volatility in the bond market. I think the curve continues to steepen in the United States, so the long end continues to rise. Whether that means the short end stays anchored or comes down a little bit, I don't think it really matters, but I think the important thing is that the long end likely continues to rise, and not for the reasons that we want it to. I think it rises because of, as I mentioned before, some of the fiscal concerns that people have, the nationalism that's going on, currency volatility, and just lower demand for treasuries, lower demand for dollars, because yields are rising around the globe. And somewhere like Japan is a perfect example of that. Japanese yields on Tuesday of this week, I'm not sure when this podcast will drop, but on Tuesday of this week, which would have been what, the 20th, um, the 30-year Japanese bond yield rose 27 basis points in one day. That is the largest move ever recorded in the history of time. Like, we literally witnessed history on Tuesday, a 27 basis point move. That's in a bond market for a country that's very developed. This is not an emerging market bond market, right? This is not a market that doesn't have a lot of liquidity, so big swings can be explained. Absolutely not. This is a large and established country, a large and established bond market. So a move like that, not just the 27 basis points, it was a 7 standard deviation move. That is humongous. And then the next day came back down 15 basis points. Everybody probably thought, oh, phew, thank goodness, right? We erased some of that move. But the volatility is still big. Up 27, then down 15 in a matter of 48 hours. That's huge. So there are clearly things going on in Japan that are going to reverberate around the globe. And because those yields have risen so much in Japan, for a long time, we relied on Japan as a buyer of treasuries. And Japan is the largest foreign holder of treasuries. Their yields are now knocking on the treasury yields level. And if you're a Japanese investor, why would you go through the trouble of investing in US treasuries, the currency volatility, because you have to convert yen to dollars to do it, when you can get a similar yield without even bothering with that currency piece of it? So the demand for treasuries is expected to come down. It, in fact, already has come down. And that's part of the reason for it. Not to mention all of the things going on with Europe and, threats of tariffs in Europe. And Europe is a smaller holder by country compared to Japan. But if you add all of the European countries up together, it's still a significant holder of treasuries. So those are things that I think are going to affect the bond market a lot in 2026. I think we'll have to pay much closer attention to global bond yields than we have for a long time.
Yeah, and the factors that cause the Japan bonds to shoot up like that, do you see those happening? Like, are those replicable factors, or were they this Dump America Day or whatever that was that kind of sparked it.
Well, you know what's interesting? I think that maybe the disconcerting thing, and I put this in the column, is that there wasn't a catalyst. It just
Mm.
started happening. There was nothing that occurred. There was no data that came out. There was no headline that crossed. It just started happening. And the reason that's disconcerting is because then, as an investor, how are you supposed to know where to set expectations? Because if this just happens sort of inexplicably on a random Tuesday, then how do I know when the next one's coming, right? You almost have to protect yourself more because who knows when that next big swing could happen. And as we know, selling begets selling because positioning starts to get really out of whack. So when there's a move that large, what happened on Tuesday was you saw a bunch of hedge funds starting to need to cover their position because the move was so big that they had to protect. And then that just exacerbates the move even more. So I think that the most unnerving part of it was that there wasn't a good explanation. We can explain it by saying, Japanese investors are worried about an increase in spending and a cut in taxes because the math of that just fiscally doesn't make good sense, right? So, okay, that would suggest perhaps a systematic reduction in demand for Japanese bonds, not a one-day move of 27 basis points. So, I think the big concern there is that now we know it's possible and that we can't predict it at all. It's not even just, oh, we can't predict exogenous shocks. Of course we can't predict those. This was a move in the markets that really didn't have a direct cause. So that was concerning. And then later in the day, I mean, it unfortunately happened at the same time as the World Economic Forum was kicking off in Davos. And there were some things said earlier in that week about increased tariffs possibly on Europe. And then that's when the Sell America trade really picked
Yeah.
up steam. So the US bond market sold off as well. Yes, it had something to do with Japan, but it also had something to do with those European comments because add both of those together, they both still likely result in less demand for US Treasuries.
Yeah. Well, it's a perfect segue into our final topic, which advisors usually start with, which is client behavior.
Hmm.
One of my favorite quotes from the behavioral finance side is, it's not irrational behavior, it's normal behavior. So let's kind of start with that. How would you, what's your best advice to an advisor whose clients feel anxious and want to make big changes right now?
Uh-huh.
There's a lot going on in the world, and I know there's a lot of advisors listening, regardless of which week it is in 2026 or 2025 or 2027, there's likely to be big things going on in the world that are going to make their clients jittery.
Right.
What would be your advice to those advisors?
Well, I'll start with one of my favorite quotes from obviously Warren Buffett, which is that the stock market is a mechanism for transferring money from the impatient to the patient. And anybody who is making moves because they're impatient about finding something out or impatient about getting more certain on a topic uh, is likely to find themselves chasing their own tail a lot. And I can say one thing for almost certain that this volatility, the geopolitical risk is not likely going anywhere anytime soon. The topic of it may change. The topic du jour may change as we move through the year, but the volatility on the geopolitical side not likely to go anywhere anytime soon. And add to that this is a midterm election year. So if you can manage to get your clients to kind of pull up, right? Pull the wheels up a little bit. Look at the bigger picture that 2026 is probably going to be a more volatile year than 2025 and then 2024 was, and then 2023. Now, in 2023, we had the regional bank crisis. In 2025, we had Liberation Day. There were big drawdowns in both of those years. They both happened early in the year, but there were big drawdowns in both of those years, and we ended pretty strong, and everybody felt pretty good by the end of the year. So keep that in mind too, that this sort of early year trepidation, these early year jitters, pretty normal for the last handful of years. So also pulling up and looking at it as even let's take all this, let's take Venezuela out of this. I know this is impossible, but let's take Venezuela out of this. Let's take Greenland out of this. Let's take Japan out of this. and just focus on the US and say midterm elections are in November of this year, in a midterm election year, the average drawdown is 19%. In a regular year, the average drawdown is only like 12 to 14%. So midterm election years are generally bumpier as it is, just like taking out all of this other geopolitical noise that's going on. So this is something that I think is important for investors to keep in mind, that this might be a dramatic year and one that's hard to sit through at times. In those years, sectors like consumer staples and healthcare tend to do the best. So that's also something to keep in mind. And I actually saw a report today about tightening financial conditions. Staples tends to do the best in a tightening financial condition environment. We talked about this earlier. What's the most underappreciated risk? Well, what if growth comes in better and financial conditions actually do tighten a bit because the Fed changes their tune? So that's another tally for staples, right? Another reason to own staples. So things like that, if you zoom out and think about it from a more rational perspective of, okay, some of this volatility is normal, a lot of it is short-lived. The market tends to overreact in the short term, both on the upside and the downside. So just because there's a headline doesn't mean that I need to do anything about it. And frankly, the better option is usually to not do anything about it. So keeping that in mind, I do think, however, investors who, if they are still very exposed to the Mag 7 or very exposed to tech stocks, meaning they're overweight the index in tech stocks, I think that it's time to consider some diversification and making sure that there is exposure to other things in the portfolio. I've mentioned many of those sectors. I won't beat a dead horse about it, but considering exposure to other things that may seem really boring and that may feel like they're not a good or exciting investment, but in a year where we expect broadening to continue, I think you're going to want exposure to some of those places.
Yep. Well, we'll stay tuned with a lot of the resources you provide us, Liz. We'll definitely get you back on the stage again. I enjoy those high ratings as much as you do. This has been a great podcast. I have one more question for you. And, we're an organization serving about 30,000 advisors. We have 16,000 certificates or candidates in our certification programs. I want to close these podcasts with just, what's your one word of advice, or what one thing you would like to say to advisors as we head into 2026, or really at any time? What's kind of your input and advice for advisors?
Let's see, one word of advice. I guess I would say stay rooted. I think that this is that's two words, sorry. So maybe rooted if we have to choose one word. This is a an era of transition for the US and for the globe. And it's an era of transition in monetary policy. It's an era of transition and perhaps consternation in fiscal policy. And politics are playing a role more now than maybe any time for the last decade. And the sort of rejiggering of trade and all of the changes that might occur and stick as the rest of this year plays out and into 2027, I think is something that we just have to accept as what's happening. And the more you fight it, the worse off you probably are as an investor. So stay rooted in the strategy that you've laid out for your clients. And I think trust your judgment, because it's really easy to second guess yourself on a daily or weekly basis when dramatic things or dramatic swings are happening in markets. But more likely than not, the strategy that you laid out with a clear head at the end of 2025 is the one that you should continue to stick to.
Yeah, that's great advice. My advice is follow Liz Thomas and what she writes and speaks. And thank you again, Liz Thomas, for your time on this show.
Thanks for having me.
Have a good weekend, Liz. Thanks again. Well, that'll wrap up our issue of the Exceptional Advisor podcast with Liz Thomas. I want to thank her for joining us again. She's always terrific. Please follow this podcast so you catch up when there's new episodes that arrive. Thank you again for your time. My name's Sean Walters. We'll see you next time.